Goldman Sachs just paid $2.25 billion for the company behind my QQQI check, and buried in the same deal, a Bitcoin ETF that just leapfrogged BlackRock by 19 times. One deal, two of my funds, a tax advantage you already know about if you've been here before, and a Bitcoin trade neither of us saw coming. Here's the actual deal. On August 12th, Goldman Sachs announced it's acquiring NEOS Investments, the company that runs QQQI, SPYI, BTCI, and about 16 other options income funds, including two I haven't covered yet, XBCI and NEHI, NEOS's boosted Bitcoin fund and its Ethereum income fund. $30 billion in assets, 19 funds, one signature. Expected to close in the first quarter of 2027. This isn't Goldman's first move like this either. Back in December, they announced a $2 billion deal for Innovator Capital Management, a company running 171 defined outcome ETFs, $31 billion in assets. That deal closed in April. Add NEOS on top, and Goldman becomes the 8th largest active ETF provider in the country. $80 billion in active ETFs, sitting inside a $130 billion global platform. This is a company deliberately buying its way into a specific corner of the ETF market twice in 9 months. Two of NEOS's funds are in my own portfolio, which is why this one's personal instead of just interesting. QQQI, the fund I told you had a tax advantage GPIQ could never match, and BTCI, the Bitcoin income fund I ran 5 price model scenarios on a few weeks ago. Both just changed hands. But here's the detail that actually made financial press outside the ETF world sit up. BTCI alone holds over $1 billion. BlackRock launched its own competing Bitcoin income fund back in June. It's sitting at $59 million. Goldman didn't build a competitor to BlackRock. It bought one that was already 19 times bigger. Bloomberg's own senior ETF analyst, Eric Balchunas, pointed out something worth sitting with. Goldman had already filed to launch its own Bitcoin covered call ETF back in April. It never launched. Now we know why. Buying the market leader was faster than building one and fighting for assets. Think about how you'd actually structure a serious training program if you were smart about it. You wouldn't put your squat, your bench, your deadlift, and your conditioning all under one coach's single philosophy, even if that coach was good. You'd spread it out deliberately, on purpose, before you ever needed to. Different specialists for different lifts. So if one of them gets it wrong, changes their approach, or just leaves, you don't lose the whole program. You lose one piece of it, and the rest keeps running. That's why my 5-fund income floor was never just 5 funds. It was 5 funds from 4 separate shops, chosen that way on purpose. Fund Strat Building, GR&I, NEOS Building, QQQI, Goldman Building, GPIQ and GPIX, Round Hill Building, T-Pay. 4 philosophies, 4 separate teams making separate decisions, so no single shop's bad call could take out the whole floor at once. This deal takes one of those 4 teams and folds it into a team that already runs 2 of my funds. Not because Goldman's bad at this. Concentration itself is the risk, completely independent of how good any one shop actually is at their job. Here's the number for my income floor, specifically. Today, Goldman already issues 2 of my 5 funds, GPIQ and GPIX, 40% from one issuer before this deal even closes. After it closes, Goldman adds QQQI, 3 of 5, 60% of my income floor, one company. And the QQQI specific risk is mechanical, not just conceptual. NEOS built QQQI on SPX put spreads, structured to qualify for Section 1256 treatment. Goldman's GPIQ and GPX use a different mechanism entirely, direct partial callover rights, the percentage of the portfolio covered changing month to month. Both land on the same favorable tax treatment. The actual portfolio behavior underneath, how much upside gets kept, how the fund tracks in a rally, doesn't match. Nobody's confirmed Goldman will standardize QQQI toward its own method. I want to be exact about that. This is not an announced change. but a company that just spent $2.25 billion building one options. Income Platform has an obvious operational reason to eventually run it as one process instead of two. That's the thing I'm actually watching, not the fund disappearing, not my money at risk. The mechanics quietly drifting toward Goldman's version of this trade. What do we actually know from precedent? Goldman closed the Innovator deal in April. 171 funds, $31 billion, folded in. 4 months later, names unchanged, the leadership team intact, no confirmed strategy shift reported anywhere. That's a real, if early signal, that Goldman doesn't gut what it buys. But Innovator didn't overlap an existing Goldman product line the way QQQI overlaps GPIQ. That's a real difference from the one precedent we actually have. And it's the reason I'm not just assuming this plays out the same way. For my floor and my BTCI position both, nothing forces my hand today. Tax treatment, distributions, mechanics, all unchanged right now. The deal doesn't close until next year, and regulatory approval for deals like this rarely gets denied outright. But it has me looking harder at the one fund in the floor that was already a question mark for a completely different reason. TPay, which still hasn't gathered real assets since launch. If I'm rethinking issuer concentration anyway, that's the seam to pull on. If this actually helped you understand what's happening instead of just seeing a headline scroll by, hit like. It puts this in front of more people trying to make sense of what it means for their own portfolio, not just this one. Subscribe if you want to see whether I actually replace TPay with Roxy or ROCQ over this. I'm auditing the whole floor next, fund by fund, and that's the seam this deal just opened up. If you're holding QQQI, BTCI, or both, are you still dripping into them through this, or pausing new contributions until the deal actually closes? Tell me where you land and why.